Hi, I'm Ross Mayfield, investment strategy analyst at Baird, and we are back for another weekly update with our friends at Strategas. Today, I'm thrilled to be joined by Ryan Grabinski. Ryan is the managing director and investment strategist at the firm, and we're going to talk all things markets today. Ryan, how are you doing?
I'm doing well. How's everything been, Ross?
Yeah, doing really well over here. Glad to get a chance to talk with you. And I think we talked recently, but let's put a bow on earnings season because we're basically at the end, a handful of companies left to report. And you took an interesting look at earnings, which is comparing what folks expected earnings to be at the end of the first quarter versus what they expected earnings to be at the end of last year, and how actually depressed expectations have a lot to do with how we view this earnings season. Could you detail that and talk through earnings a little bit for me?
Yeah, absolutely. So obviously, we've seen the headlines in the newspapers, how earnings season has come in significantly stronger than what was originally anticipated. I think there's a pretty big caveat to that data, though. If you look at the estimates at the beginning of April, the S&P was expected to see earnings down about 5%. The numbers that have been reported over the but at the end of last week actually came in where earnings were just down a little less than 1%. So that looks really strong. The percent of companies are beating are at the highest level in several quarters. But I think you have to take a step back and look at this in a broader context. If you actually look at the estimates from January 1st, the S&P was expected to grow a little more than 1.5%. Now, basically what is ultimately happening is that during the first quarter, analysts revised down their estimates pretty significantly. Then when those earnings were ultimately reported, companies ultimately beat those revised lower estimates. But what they're not beating is they're not beating that initial expectation that was put out there at the beginning of January. This is pretty classic behavior from analysts, but this quarter has certainly been a little more extreme than what we've seen in the past.
Yeah, and I think on one hand, analysts revising their expectations down is something that needs to happen when the economy starts to downshift. It resets sentiment a little bit. But at the same time, that context is really useful for how to think about an earnings season that, as you mentioned, has been talked about as quite strong, and in some ways is, but with that caveat. So another big piece of the market that is getting a lot of headlines and a lot of attention is this concentration at the top of the market. It was a big topic of conversation in the previous decade when big tech led the way, and it was a handful of big companies. And that conversation is back and kind of in a bigger way than it's been in a long time. So what are you all seeing on that front, and what does it mean for how you view the market?
Yeah, so obviously there's a lot of statistics that are being thrown out there. One that we've been using is that roughly 90% of the gain this year in the S&P is attributable to just 10 stocks. And while that's true, it's not all that unusual. One of the things that we actually look at is we look at the S&P 500, which is a cap-weighted index, and we compare that to the S&P 500 equal-weighted index. And when you look at the difference between the returns on those two indexes for the year, you can see that it sits at about 800 basis points at today. There's since 1990, there's only actually been three other periods where the spread has actually been wider than that, and it was 98, 99, and 1990. Now, what does that have to do with today? Is if you think about those three instances where it was wider, those are actually more of end of cycle type performance or end of cycle years. Obviously, in 1990, we had June ended up being a recession, and then obviously in 1998 and 1999 were the last 2 years of the great bull market run of the 90s before the tech bubble popped. Now, that's not to say that the equity markets have to go down from here, right? The nature of a cap-weighted index is that it actually can be sustained higher for longer with just several companies, but it is something to think about when it comes to the breadth of the market. Obviously, performance isn't vast when you do have just a few companies leading equities higher.
Right. Yeah. Something just to keep an eye on. I mean, it's been a topic of conversation before and hasn't always led to calamity, but all things equal, you'd like to see kind of a broader rally. All right. I want to end here. We've ended here, a couple times in recent weeks, which is, amid all of the headwinds and kind of negative press out there, I want to end on something that you're optimistic about or excited about within the market.
Yeah, so this is actually a pretty interesting observation. I think I came across earlier this week. So I was looking at asset class valuations, And we've seen a lot of money flow into money market mutual funds, and that makes a lot of sense to us. If you look at, if you put it in terms of a multiple, so the multiple on money market mutual funds is roughly, it's about 19.7 times. But what is actually most interesting when you look at other asset classes is that the second cheapest asset class is actually equities right now. And despite them trading at about 20 times earnings. So I think, for all the negativity that is out there, the idea that equities are expensive, when you start looking at them relative to other asset classes, they actually are more attractive than one would initially think.
Yeah, and everything's relative. I mean, when you have money, it has to go somewhere. So I think that's a really insightful and probably unexpected observation. So as folks continue to invest in equities, something to keep in the back of their mind. Ryan, thank you so much for the time today. Super insightful as always, and hope to talk to you again soon.
Absolutely, Ross. Thanks.